Yo, it's Sammy Trades NQ back with another video. Today's video is fair value gaps explain the clean way to trade imbalances. What if I told you that the market leaves footprints when it moves too fast and it often comes back to clean them before continuing? If you learn how to spot it, trade with confirmations, then you'll start seeing entries that look like the market is handling you the setup. What's good, everyone? Welcome back to the channel. Today I'll be breaking down a fair value gap, what they are, how to mark them correctly, why price returns back to them, and my simple rules to trade without guessing. Let's get into it. What is a fair value gap? A fair value gap happens when price moves so aggressive that it skips trading at a certain price, like this. So if we have it here, it skips trading through this price, and you see these wicks. These wicks they're not here, and it leaves a gap with here, and this candle moves right. And you could have, and it's just 3 candles. It doesn't have to be the same color. It just has to be an imbalance of price right here and right there, as well as here. You have one here and here. This one's a really common. This is 3 candles. It has to be 1, 2, 3 candles. 1, and you see here. And then what you're gonna do is draw your rectangular tool on the top of that wick and the bottom of that wick. So the bottom of this wick, the top of this wick, tip wick to wick, bam, bam. Now you just did your first fair value gap. Perfect. Think of this like this. In a normal market, price trades smoothly. So there's equal wicks, just like this. It just trades smoothly. There is no gaps or imbalances. And buyers and sellers exchange fairly across a range. But when institutions slams the market with orders, when these institutions have so many hundreds of orders that basically us retail can't, we're only 5% of the market. The institutions are the other 95% of the market. When they have billions of dollars that they just throw into the market, it makes these imbalances. But when price jumps and gets an imbalance, the imbalance is a fair value gap, and later price will often come back to the zones to rebalance before moving again. How to identify a fair value gap? You need three candle rule. 1, 2, 3. A bullish fair value gap expects price to return into it, then bounces. You need 1 candle has a high. 2nd candle is a big impulse candle, which is this one. So boom, boom. And the 3rd has a low. Boom, boom, boom. If candle 1 is below candle 3, that gap is between a bullish fair value gap. Mark candle 1 through candle 3 low. Candle low high through candle 3 low. A bearish fair value gap is, I could find one real quick, hopefully, blah, blah, blah. Let's see. Perfect, this one. This one is a bullish fair value gap because it's 1, 2, 3 in the bullish form. Right there. Candle 1 has a low. Candle 2 is a big impulse candle where there is a gap. If we could move this away, there is a gap in between these wicks. It is not fulfilled and it's not perfect. So there's an imbalance, and we basically mark it from wick to wick. Bam and bam. It's usually easier when you just start. Bam. Perfect. Simple way to remember: big impulse, likely imbalances, likely a fair value gap. Why fair value gap works? Fair value gap works because the market is basically doing 2 things all day: delivering price to a destination and rebalancing inefficiency left behind. Those are the 2 things that price action, in my price action video, was the major concept. That First one is delivering price to a destination, and the second one, rebalancing inefficiencies left behind. So when price leaves a gap, it's likely unfinished business. That's why you'll see prices rip away, pause, then come back and tap a fair value gap, then continue the original direction. Not always, but often, that it becomes a real edge if you use context. The biggest mistake when using fair value gaps is where people get cooked is when they see a fair value gap and they instantly buy or sell the moment the price touches into a bullish or bearish fair value gap. That's not a strategy, that is gambling. You need confluences, so you're trading fair value gaps that actually matter. The 3 filters that makes high probability fair value gaps. If you only remember one part of this video, remember this: filter directional bias. Trade fair value gaps in the direction of the trend on your session bias. If the market is clearly bullish, prioritize bullish fair value gaps. Filter 2, location matters. Best fair value gaps form after a sweep of liquidity, taking out highs or lows near key levels or previous day highs or lows, or session lows or highs, equal highs or lows at discount premium, cheap versus expensive price area. Filter 3 is confirmation entry. Instead of entering on a tap or wait for it, a shift of structure, like a break of structure, minor like a higher lower, a lower low or lower high, or a strong rejection candle from this inside the gap. This is how you stop getting trapped. A simple clean trading model, and here's a clean fair value gap play you could literally repeat. A bullish model: market sweeps liquidity, takes out low, strong impulse that creates a bullish fair value gap. Price returns to the fair value gap. You wait for a confirmation, a structure shift, a rejection, enter a long, stop below that low, and created the move. Target previous swing highs, liquidity pools, or session levels. Bearish mode is the same but flipped. Risk management: quick risk rules. Don't use giant stops. If the fair value gap is valid, it shouldn't need a mile of room. If the price completely blasts through your fair value gap, hold above and below it, and the idea is it is likely invalid. Aim for at least a 1 to 2 award to risk. Ideal a 1 to 3 is clean. And yes, and let's see if I could pull up some examples on what a fair value gap trade would look like. So let's see if I can let's go to the 4-hour. Market is kind of closed already. So we're going to see here, let's get to like a good time frame, 9 o'clock-ish. Perfect. Let's go to Friday. Let's go to the 1 hour. Let's make this a little bit larger. Bang, bang, bang. All right. Let's go to the 30 minutes. 5 minutes. Perfect. So we got this fair value gap, right? And let's go to 9:30. Perfect. This is 9 o'clock. We got this fair value gap that is formed. We see that it retested some here. It went through, swept this liquidity. It went through, pushed through this, it pushed for a first push, then it came back up, then give us a second push. You get into a short, you're short here, you put it right here, and don't trade this unless it like give you like some, at least, a fair value gap on some key levels, or you have other confluences of taking a fair value gap. I just wanted to show that you could take a fair value gap and that it is proper to do that, to kind of previously just like snipe these or preempt them. But yep, that is a kind of like a trade idea of how to take a fair value gap. This is personally not like a clean setup that you're like, this is what you should take all the time. This is just an ideal thing just to put a short, just to put a short position onto it to see how it would look. Yeah. So that's what fair value gaps are. And I'm going to give you a quick overview. It's an imbalance, it's a return on imbalance, a continuation, but only when you have context. If you want a part two, I could do a part two in the best time frames to mark fair value gaps, how to avoid random fair value gaps, and live charting examples with entries. Drop fair value gap in the comments below and I'll make it. Like and subscribe, and I'll see you on the next one.